Let us now discuss some miscellaneous points in this unit. First, effect of admission by a partner. Any admission or representation by a partner binds the firm. Now, admission here does not mean admission of partner. That is the partner getting admitted to a firm. Admission here means representation or acknowledgement. That means any agreement where a partner accepts, yes, I'll do this, the firm will do that. We'll sell you 100 units, we'll purchase 50 units from you. What is he doing? He's acknowledging. He's representing the firm. He's making a representation on behalf of the firm. So whatever representations, whatever admissions, whatever acknowledgements a partner makes on behalf of the firm gets bound by it. This binds the firm. The condition is this admission should be related to the affairs of the firm. It should be related to the business of the firm, and it should be made in the ordinary course of business of the firm. Okay. Next, effect of notice to an acting partner. Whenever any notice is given by a third party to a partner, it is understood, it is assumed, it is presumed that the notice is given to whole of the firm. It is presumed that the notice is given to the whole of the firm because the partner is the agent of the firm. The partner is the principal of the firm. So whenever any notice is given to the agent, it is assumed to be given to the principal, that is to the whole of the firm. And he is also the principal. That means the firm is his. So when you give the notice to him, it is assumed that it is given to the firm. So the firm and the other partners get bound by it. Now the important thing here is he should not be a sleeping partner. He should be a acting partner. He should be a working partner. Because if he is a sleeping partner, the firm will not get bound because he is not representing the firm. He does not work for the firm. He's just given his capital. So any notice to him will not be considered as a notice to the firm. However, any notice to a working partner or an active partner will be considered as a notice to the firm, and the firm will then get bound by it. Again, the second condition is fraud should not have been committed by the third party against the firm. That third party should not have committed any fraud against the firm. So if the third party has committed fraud and then given a notice to the acting partner, it will not act as a notice to the firm because that party has already committed a fraud against the firm. Okay. Next topic is liability towards third parties. What are the liabilities of the partners towards third parties? First, they have a contractual liability. Whatever dealings the partners make with third parties, they have a contractual liability. They are bound by their words. They are bound in such dealings. They will be liable. And how are they liable? They are liable jointly and severally. What do you mean by jointly? Jointly means all the partners together are liable. All the partners together are liable. So if, let's say, the firm had taken a loan of 1 lakh rupees and there are 4 partners, every partner will be liable for 25,000 rupees. If one partner does not pay, that amount will have to be again shared by other partners, but they have to jointly pay it to the third party. They are severally liable also. The partners are severally liable. Each partner individually is also liable. The third party can recover whole of the amount from one partner also, because he is severally liable. He is liable for the whole of the amount. He may, in return claim it from other partners. That is a different thing. But the third party can claim the whole of the amount from any partner, any one partner, and he'll have to pay because he's severally liable. Next, liability of firm for wrongful act or tort of a partner. If a partner involves in some wrongful act or tort, this is TORT, not trot. This is tort, and tort again means civil wrong, a wrongful act. Okay. So loss or injury, if there's some loss or injury to third party because of a wrongful act of a partner, then all the partners are liable. The firm gets liable. The condition is the wrongful act of the partner should be connected with the business and should be in the normal course of business. Now, you know, let's say the firm is into the business of welding of goods. Now, what has happened is while welding, the sparks, fell on the clothes of some third party. Now, this is a wrongful act. So, what do you think? The partner who did this act will be liable, or the firm will be liable here? The firm will be liable because welding is connected to the business of the firm. Secondly, it was done in the normal course of business of the firm. He was acting on behalf of the firm. So only that partner will not be liable, but all the partners taken together will be liable. The firm will be liable because the wrongful act was committed by the partner in the normal course of business of the firm. And again, it was with authority. Third, liability for misappropriation by partner. Now, what do you mean by misappropriation? Misappropriation means, mishandling of the funds, embezzlement of the funds. Now, in short, committing frauds with regards to funds of the firm. So, where a partner receives money from third party and misappropriates it, that is, puts it in his pocket or pays his personal expenses, or the firm receives money from third partner and is misapplied by the partner. Firm receives money from the third party and is misapplied by the partner. The firm received the money from one of its customer but this partner showed that no money has been received and took the cash and paid his personal expenses. So what is he doing? He's misapplying the funds of the firm. So if the funds of the firm are misapplied, the third party will not be liable. The third party has paid it rightfully, so you cannot again make it liable. The partner here will be made liable. Okay. What about personal profits earned by partners? That means, let's say if a partner is making some secret profit, making some personal profit by using firm's property, by using firm's goods, then is he allowed to do so? And what about the profit? Let's say if he has already done it, so is he allowed to keep the profits or he'll have to give it to the firm? Let's study. So if there is any profit by using firm's name, by using firm's property, by using business connection of the firm. So let's say a partner is doing a personal business, but in the name of the firm, he is showing that he is, dealing in the name of the firm. He is dealing for the firm. Or if a partner is using firm's office to do his own business, firms go down to do his own business. Or if a partner is using firm's contacts, using firm's creditors or debtors to do his own business, or he's doing a competing business with the firm, then the partner has to return the benefit to the firm. Now the benefit may be profit that he has earned by using the firm's name, by using the firm's property, by using the business connection of the firm. If he has made any profit, he has to return it to the firm. Or if he is doing a competing business. Now, what do you mean by competing business? Competing business means that the partner is doing the same business in his own name. He's competing with the firm in the same business. Let's say the firm is into the business of selling garments. The partner is also doing a competing business. He is also selling garments, and he's in the competition with the firm. So whatever profit he makes in his own business, he'll have to give the profits to the firm, because it is a moral duty of the partner to not to get into competing business. Now if he had to do competing business, if he had to do it singly in his own name, then why did he get into partnership? So getting into partnership makes no sense then. The purpose of getting into partnership gets defeated. So whenever a person gets into partnership, it is his moral duty to not to do any competing business with the firm. And if he does and he makes profit, he's supposed to give that profit to the firm. He's supposed to return the benefit to the firm. So what do you think would be the case if he makes loss? Will the firm be liable for the loss? No, the firm will not be liable for the loss. If he's using firm's name, firm's property, or firm's business connection to do his personal business and he makes a loss, then he'll have to be liable for the loss. In this case, the firm will not be liable for the loss. But if he makes profit, then he'll have to give it to the firm. So the exception is non-competing business. If he is not doing a competing business, let's say the firm is into the business of selling garments, and the one of the partners also does the business of rendering IT services or selling of computers, then the whatever profits he makes from the non-competing business will not be liable to be given to the firm. He is not liable to return the benefit there. He can keep the benefit, he can keep the profits. Okay. Now, this is a very important topic, partnership property. What do you mean by partnership property? What does it mean? Does it mean the immovable property, or does it mean the movable property like goods, machinery, or does it include both? Does it include intangible assets? What does the partnership property include? What does it mean? Let's see. Partnership property is comprised of, first, any money, any assets initially contributed by the partners. Important word here is assets. any, money, capital, assets which are initially contributed by the partners becomes the firm's property, plus any acquired assets acquired in the course of the business. Once the firm has started doing the business, and slowly and gradually it has acquired assets, it has acquired goods, it has acquired property, it has acquired machinery, it has acquired debtors, all this becomes firm's property. Third, goodwill also is firm's property. Though goodwill is intangible, yet it is firm's property because goodwill can be sold. While selling the business, goodwill can also be sold. So goodwill is also firm's property. It is not the property of any one partner. So there are three components of partnership property. First, the assets that are initially, while starting the firm, initially brought in by the partners. Second, assets that are built up during the course of business. While doing the business, the assets that the firm acquires, it may be in the form of goods, it may be in the form of cash, it may be in the form of a godown, an office, a factory, it may be in any form. And finally, third is goodwill. Goodwill is also considered as the property of the partnership. Now, there's one question which is, which students generally have a doubt about. Let's see. If a partner's property is used for firm's purposes or for firm's businesses, does it become firm's property? Let's say one of the partners brings in, his office as the capital, as the initial contribution. Does it become firm's property? Yes, it becomes firm's property. But here the case is, the partner does not bring in his office as initial contribution, but he allows the firm to do business in his office. Now, these are two different things. Bringing office as initial contribution in the form of capital, and second, not bringing it as capital, as initial contribution, but allowing the firm to do business in his property. So if he allows the firm to do business in his property, does that property become firm's property? That property does not become the firm's property, because what is firm's property has to be decided by the partners, has to be decided by the firm. It depends upon the intention of the partners. If the partner intends, if the partner is of the opinion, yes, this is firm's property, then it will become firm's property. If the partner says, no, this is my personal property, then it will be the personal property of the partner and not the property of the firm. So let's see the answer. No, it depends on the agreement between the partners. It depends on the intention of the partners. It depends upon the agreement of the partners. Now let's study about goodwill. How do you define goodwill? There's no specific definition about goodwill, but normally what we understand of goodwill is, it is the brand value, it is the reputation that a company has, that a firm has, that a product has. It is, the value that a particular name has, that a particular brand has. It is the value that a particular person has. Second, it is acquired in the course of business of the firm. Now, goodwill is gradually earned. Goodwill is gradually acquired. You build goodwill, you develop a goodwill. You cannot have goodwill right from the first day, because you haven't done the business, you haven't given service to public. How can you have goodwill right from the first day? No. Goodwill has to be acquired slowly and gradually in the course of business, and thus it becomes the property of the firm. Because it is acquired in the course of business, it is firm's property. It does not belong to one partner, but it becomes the firm's property. Can goodwill be sold? Yes, goodwill can be sold, but what are the conditions? Let's see. It can be sold with other assets or separately. So when you are selling your business, you can sell the goodwill along with the assets of the business, or you can separately sell them. You can only sell goodwill separately. You know, let's say I am doing a business. I am mm, I am a person who makes sweets. So I am a halwai, mithai wala, and I make a lot of profit from this business. However, I am aging. Let's say I am turning old. So now I do not want to continue with the business. So what I do is I give my name to somebody else who wants to continue the business. So what I am doing is I am giving my name to him. I am giving my goodwill to him. So here I am not selling the other assets. I am not selling my shop. I am not selling my workshop. I am not selling my restaurant. I am not selling the utensils. I am not selling any other assets. I am only selling goodwill. So it is separately being sold. Whereas, I may also opt to sell the shop. I may also opt to sell the utensils. I may also opt to sell the workshop and the other assets of the business along with goodwill as a complete package. I can do that also. So goodwill can be sold both ways, either with other assets or it can separately be sold also. Second, buyer and seller may make a non-compete agreement. What is a non-compete agreement? A non-compete agreement is an agreement which restricts the seller from engaging into the same business. Now, when I am selling my goodwill to you, can I continue with the business? No, I cannot. Let's say Cadbury sells the brand, the goodwill of Dairy Milk to Nestle. Do you think Cadbury can continue selling the chocolates Dairy Milk? No. Now this brand has been bought by Nestle. Now Nestle will sell the chocolates by the name of Dairy Milk. So can Cadbury compete Nestle in producing and selling Dairy Milk chocolates? No. So buyer and seller normally enter into non-compete agreement wherein the seller of the goodwill will not compete with the buyer in the same goods, in the same services. Otherwise, then what is the use of purchasing goodwill? Then the purpose of purchasing the goodwill gets defeated. Okay. However, this non-compete agreement, this restriction may be with regards to some specific area. Let's say 2 kilometers of area or 10 kilometers of area, or for a limited period of time. That is, let's say for 3 months, for 6 months, for 1 year. That depends on the agreement. Okay.